All right, Tom, you are back live and direct.
Yeah, live and better than before.
Okay, perfect, perfect. So, we left off. We were trying to get a brief intro from you. How long you been in the industry, and then just give us a little background of yourself
Yeah, well, I jumped into industry in 2018 after 35 years in tech.
in tech. I gotcha. And what was the reason for the move? I mean,
Well, yeah, if you might have seen one of the reels I posted about earning about $1 million in 2017 and then losing about 400,000 of it to taxes. I said I didn't want that to happen again. I started digging into some financial solutions, and that landed me here. And I decided that yeah, I could do this instead of going back to the W-2 grind. I could be self-employed and enjoy helping other people with finances. Yeah.
gotcha. So you were one of the people that actually felt the loss. What year was that when you experienced the what? How much was it? What did you say?
Tax year 2017, federal and state combined was close to $400,000.
Wow. So
Yeah,
you
so I
you
paid my
you
fair share.
you were tired of giving your hard-earned money away.
Well,
To,
the, so I live in San Francisco Bay Area,
there you go.
and there are three bridges in the area. If you go clockwise around the bay, like you go over the Golden Gate north, then you come back over I think it's San Martin, I don't know,
Martinez Bridge.
Martinez Bridge, yeah, that's it.
Yep.
And then come back down over Benicia. If you go
Yep.
clockwise around the bay, you pay no tolls. If you go counterclockwise, you pay tolls. So what is that about? You're not evading tolls by going clockwise, and you're not evading taxes when you properly arrange your finances. It's called avoiding taxes when you don't need to pay them.
There we go.
Yeah.
Yeah, and that just comes with the plan in place. Like you said, just knowing being from the Bay Area, if you go a certain direction, you will number one be either taxed or non-taxed, and it's really up to you on the route that you want to get there. Similar to the financial realm, to where if you know of a strategy that you can legally be tax-free category, it may be in your interest or your best interest to put yourself in one of those categories. Because I know there are a lot of investments out there that are going to be taxable, and then there are very few that are tax free. And
Right. And yeah, I would say tax efficiency, that's something that you and I think, are really interested in, because in some cases you can avoid taxes, but how can you be more efficient? And certainly, I don't want to face tax bills like that in retirement. I'm closer than retirement than you are, obviously. You might see my gray hair here.
I thought I was going to beat you in that race, but I guess
Yeah,
not.
maybe you can retire early with all the money you're making. Okay, so but I do know that there's some of that money I earned, I just couldn't avoid the classification. It was, RSUs, et cetera, stock options, things like that, that
Yeah.
came in and were accelerated. So they became income in that year I left that company. And you could look me up on LinkedIn if you want to see some of my background. Thomas Southard, Thomas, Southard, S-O-U, spell it really fast, Southard. Okay, anyway, where was I going there before I got distracted? Yeah, squirrel. So my dog, I have a dog here, totally distracted by squirrels. But so what could I have done different to avoid tax on that? Nothing. But if I had a tool that I have in my toolbox now, I know
Yeah.
I still could be making money on that $400,000. Do you know what I'm
Yeah.
talking about? You want to talk about that?
Yeah. So just to recap, you had a nice large lump sum payout from your previous employer, and 400,000 of that was paid to the IRS because of the amount of income that you made in that specific year. You're saying that 400,000 is now unable to work for you forever going forward, and there is a way to actually say put it into a system where you'll actually retain the value even though you did pay off the IRS. That's specifically what we like to refer to as the IUL. Some of you may have heard of it as the flip method, meaning we're able to put active income that we make into a policy where it's going to retain the value, and then we're able to take a loan from it and actually pay whatever that may be. In his case, $400,000 worth to the IRS. This may be bills. This may be other assets. But the main, no matter what the solution is in your case, being able to utilize your same dollars in two places is pretty much what we wanted to get on here and just answer a few questions and give some examples of the experience. Tom, you want to add anything to that?
Yeah, so I am now having, it's fast forward from 2018, so it's been 8 years. There are certain IRS rules about life insurance and IULs that cap what you can put into a policy.
Yep.
And we're able to use techniques that a lot of insurance, probably 99% of agents don't use.
Yep.
Certain MEC tests, I'll just say it, CVAT, we use the cash value accumulation test. After 7 years, you can put as much money you want. Up until then, you're limited by how big of a death benefit you start out with. So my policies now are past the 7 year mark. And so if I had that $400,000 today, I could, before I paid taxes on it, I could have put it in this account. And then when the taxes came due, let's say 13 months later, if I got paid in January, 15 months later in April, I could pay out, and I would have earned already let's say 7% on average. And then not only that, but that money will continue to earn because I'll borrow it out. Might borrow it out at 4 or 5%, but it's always going to be earning from then on. So if I had done that back in 2017, I would have already made, I calculated about $250,000 on that 400,000 I had to spend. Now, of course, I didn't make anything on it in the last 7 years. But again, if I had, I would have made, let's say, if it's a 2% difference compounded, it would have made about 250,000 so far. So that's the kind of thing we want to do. We want to, every dollar that passes through our hand, we always want it to make money for us in the future.
For sure. You put a lot of things out there that some people may not know the context to. You said that there was a limit for, let's say, 7 years in this policy that you're discussing. Who is the one that dictates the upper limits of a policy?
Well, the IRS has rules on that, and they're saying this came about in the 70s. They decided that too many people were taking way too much advantage of these cash value life insurance policies. So, the IRS wants to make their money, and so they said, okay, if you want to put this much money in your policy, you have to be buying at least this much death benefit. And so what we'll do is we'll try to get the least amount of death benefit for the most amount of money we can flow through a policy, because that way all the excess beyond what's going for the cost of the policy can be earning money.
Yep. And why would you think why do you think the IRS of all people has the capability or the judgment to put governor, if you will, on these policies?
Well, yeah, I think this money in your policy grows tax-free. That's what you wanted me to say. The money goes tax-free. And not only that, but in the future, when I want to access, if I had that $230,000 that grew in that account, I could access it today, tax-free.
Yep.
And when I say access, I would borrow it. But people go, oh, it's a loan. No, it doesn't show up on your credit report. Why? Because it is what kind of loan? It's I'm forgetting the name of it, non-recourse loan. It's collateralized against your death benefit. Your death benefit will pay it off. Let the insurance company pay your debts for you. That's
exactly. Money that you're able to utilize the money tax-free. It's not going to be reported on your tax returns at all, and can literally utilize those funds indefinitely as long as there is cash value growth in these policies. And that's what Tom really opened his eyes to when he experienced the tax hit that really hit for $400,000 a few years back, almost 10 years ago now.
Yeah. So Anthony, do you talk to any young couples, young families that have kids maybe that are 5 years old or maybe younger even? You talk to kids families like that? Yeah. Oh, so if they're thinking about financing college education in the future, they might have to fill out a FAFSA form to see if they qualify for any financial aid. I filled it out the first year for my 3 kids, and after that I didn't fill it out again because I just didn't qualify. I just made too much money. And okay, fine. But if you want to help save up for your college education for your kids, when you have that savings, that will be counted against you on your FAFSA form for the college education. So
the money that they save,
because you prepared yourself and you prepared to finance your kids' education, you won't qualify for certain programs or grants because you have too much money. Well, if you put this money in a life insurance policy on your kid, for example, and then later when they're in college, you could be drawing out of it, and that will not count on the FAFSA. That money in your life insurance doesn't count on your FAFSA.
So basically, we're getting penalized to save in, let's say, a 529 plan.
Yeah, 529. Yeah, don't use those. They're too limited. That's the other thing. When we talk about things like IRAs, Roth, 401ks. There's a lot of liquidity restraints on those policies, where you can spend the money, when you can spend the money, or you might get like a 10% penalty if you access it too early. That doesn't happen with cash that's accumulated in a cash value life insurance policy.
So a lot of these, let's say, government plans that are out there, it sounds like they limit the amount of money you have access to, where you can utilize the funds, and they disqualify you on other, let's say, qualified, or I don't want to say qualified, but other government aid in the future if you were to send your kid off to college to better themselves. Is
Yeah,
that true?
yeah,
It sounds on one note, they're saying, hey, this is a good deal. And then when you actually need the funds, it kind of gets flipped upside down on you.
yeah. I mean, there's just a lot of advantages of using cash value life insurance. A lot of people have heard about become your own bank, right? Or infinite banking concept. And the flip concept takes the infinite banking concept to the next level. It's like hyperfunding it. And
Gotcha.
if you want this policy to start generating funds, for example, I had a young client in the 30s. Their housing cost was about $30,000 a year for the mortgage, utilities all in.
Gotcha.
And they had an extra, about $15,000 that it was not earmarked for anything. They already
Gotcha.
matching their 401k. And I said, let's take $6,000 of that, match it with the $30,000 you're paying for your mortgage. We'll put $36,000 in the policy every year, but we'll take the $30,000 out every year to pay for your expenses on your house. So you're out of pocket each year $6,000. We'll do that for 7 years, and then for 8 years we won't do anything other than put money in and take it out. And then by the 15th year, after the 15th year is done, and you're all in it, 7 times 6 is 42,000
Yeah.
over 7 year period. After the 15th year, it's going to start spitting out enough money to pay the mortgage.
You basically
Yeah,
showed them a way to cut a 30-year mortgage into a
basically, I
7-year
turned a
payment.
30-year mortgage to 15 years. Not only that, and of course, they also have life insurance. So if they die, there's life insurance to pay off the loan so the spouse has money. But when they get to the retirement age, let's say 65, can start taking out an extra 200,000 a year and as much as 500,000 a year by the time they're 85. All from that 42,000. Just in 2 years, the 16th and 17th year, it's already made back the 42,000 they put in the first 7 years.
And that's really going to be the magic of compound growth and never really spending your money. You're literally leveraging your money and spending the insurance company's money in this case. We do got some questions in the chat over here on the TikTok side from you.
Buy term and invest the difference. Okay, so I am a fan of term insurance. So for that young man I was talking about earlier that was in his 30s with the $36,000 going into policy, also have a $2 million term life insurance on for the first 20 years of his life, because that will get his kids in and out of school. By then they'll be out of college, and he's got that extra coverage. And by that time, the IUL, which has only got that 42,000 funded in the first 7 years, is going to replace the term policy.
Oops, it looked
Yeah,
like you might have a. Okay, you're back.
yeah, I had a power mode warning there. That's something you can't get out of, let's say, a 401k, an IRA, a CD, a government bond. You don't get the life insurance because death and taxes, right? Those are two things we're assured of.
For sure, and
So
I'm not sure.
we're trying to deal with both.
Oh yeah, and like you said, someone working at Apple, I'm pretty sure they're making a decent wage, especially living in the Bay Area, and for them to literally tell you that they were going to quit their job if anything was to happen to their wife, that tells you the value of a stay-at-home mom, even though they may be just staying at home on paper, not receiving income. How much money are they going to be saving you by taking care of the household, making sure everything's clean, cooked, kids are where they need to be? And in that situation, they had a disabled daughter, and if something does happen to the wife, what happens to the daughter when the dad's at work? You're gonna have to get like a in-home care or send her off to
It's
like a daycare daily, and that's a
some
bill in itself.
in a business, this would be called a key man policy. So if you have a right hand man, woman in your company, and if something happened to them and it would totally disrupt your business organization, you would take out a life insurance policy to help protect your business. This is the
Exactly.
same thing you want to do at home. You have a key family partner policy. I was thinking about the term leverage. You're familiar with leverage, right? Most people use leverage to buy a bigger home than they can afford on their own. So they get a mortgage, right?
Yep.
They borrow a loan and secure the mortgage loan against the value of the house.
Mm-hmm.
When I want to go back to, you said, when I got into this life insurance business, I was introduced to something called Kaizen, which was premium financed life insurance, and probably something most people have not heard of. And what this means is I borrowed money from the bank to fund my life insurance policy. And the bank was happy to do this because they knew they had a guarantee, because they had my death benefit, and they also had cash value that they could secure in that policy.
So they had the death benefit if anything was to happen to you.
Yep.
And then they also had the cash value that was growing in that policy, that they were the ones to actually front the money as a double back security, meaning if anything was to happen either to you or to the deal, they still had their money. There was no risk on their end that
they had no risk. They had no risk. Mm-hmm. And so when I started looking at with one of my fellow engineers here, who used to work at Taiwan Semiconductor, he showed me how I could do the same kind of plan, but without all the handcuffs. So this premium finance plan that I was doing had a lot of handcuffs to it. I had to put in this case, the way I programmed it, $100,000 a year for 5 years. The bank was matching that, and then for the next 5 years, the bank took my match and their match together. So it funded it for 10 years, couldn't touch it for 15 total.
Gotcha.
And so it became this really locked up plan. And what you and I have discovered with Flip, we can we're self-financing. We're premium financing our own policies by putting all of our expense money in and then borrowing it back out. The loan, instead of from the bank, is from the life insurance company. Yep. And so we're using leverage to buy more life insurance than we can afford, and to accumulate cash value for the future that can be accessed tax-free.
Exactly. So I got a question over here that says, why would I want to loan my own money?
Okay, try to go out right now and get a loan.
Try to go out right now and get a loan.
Right. So one of my friends just got a loan for a car he bought, 8% interest.
8% interest, yep.
Right. Would you rather pay 8% or 5%?
5 all day.
Okay, yeah. What if you had already had $50,000 in your life insurance policy, and you borrowed against that? You didn't borrow it out. It was still earning 7%, and you're borrowing at 5%. So that 50,000 is still making on average 2% forever, compounded, and probably more, because we see the spread between 2 and 5%. This last year, my one policy, the least amount it earned on any segment it was earning. So each segment matured every month. There's a new segment depending on how much the money going in. The smallest I earned was 7.5. The highest I earned was 18.65. So I was earning well above the average 7%. But there'll be some years that will be lower than that. But the spread between the loan and what you're getting crediting is on average between 2 and 5% is what we studied. Because of some of the strategies, you get to choose which index strategies you're using in your policy. And the one strategy I was able to choose in this one account is really performing well.
I got you. We got someone over here, a heckler. He goes, you guys are playing with money and making it sound like a deal. And you see this just in different avenues, because it's not just insurance that knows the power of leveraging. It's also in like stock markets. You see someone like, let's say, Jay-Z and Beyonce, they have a lot of money, meaning they're billionaires as like a couple together, and they recently bought a home on the West Coast, and they took out a mortgage for a few $1 million. They're worth $1 billion, but they took out a loan for $1 million. And why would somebody do this? Why would you not just pay the full amount in cash?
Yeah, I can imagine that they're able to invest that money and see returns far greater than the interest cost on their mortgage.
And so that's exactly it.
I mean, that's exactly liquidity. Liquidity is as well as cash flow is really what matters.
Exactly. So they bought a piece of real estate, and instead of spending their own money, they're going to borrow the bank's money.
That's right.
Why? Because the bank's going to give them cheap money, as opposed to having to liquidate whatever their funds are at right now, pay down a full value of a house and not earn interest on that money anymore. Same thing, you have Elon Musk, who he owns plenty of shares of his own company, but instead of selling shares to go buy other assets and fund his lifestyle, what you'll see him do is get a note from the bank saying, hey, I have this much stock worth this much money. Give me a loan today so I don't, number one, have to pay taxes, and I can still be liquid as far as have my cash available to do what I want and not really have to bypass these tax loopholes, because when you sell, typically it does incur a capital gain. So there's a strategy to this, and you see this in different avenues as far as industries. This is just one of the ways that you can utilize your own income and being able to leverage it in two places, because where else can you do this besides someone like somewhat like the IUL and not be taxable? Because you can do this in other places, but literally this is going to be one of the only ones where it's not going to be taxed and there's no strict repayment terms. Meaning, if you took money from like your 401k, number one, you're going to be limited on how much you can take, and when you do so, they're going to mandatorily make you pay back the money that you borrowed. They're going to make you pay back your own money, which that doesn't sound too smart if just looking from the outside looking in. If I was to give my money to somebody and then they're going to tell me when I get to utilize it, I'm not going to know how much is going to be taxed, and growth is not certain. Yes, it's been a great accumulator of wealth, but it may be one of those times when the market dips when you need the money the most. And that's literally one of the things that I tell you: don't sell when the market is red. So you don't really have control of, say, that roller coaster ride that you're on.
Yeah, I was thinking about how there was a question earlier. Why would you borrow from yourself? Well, if you did have 50,000 in your life insurance policy banked away and you wanted to buy a car, you could borrow out as much as you wanted to pay off that car. Let's say it cost 50,000. So you borrowed 50,000. You don't have to pay back that loan. If you borrowed from the bank, you'd have to make regular payments or it would be repossessed. There's another. So, you have some kind of blip in your income. It's like, and you were paying back your loan because you wanted to make sure that money was available for you in the future because you borrowed it out. Maybe, your kid was only 12 and there's some money in there for his college education. You borrowed it out to buy a car or something, and you're going to just pay it back that way. Yeah, you have a blip in your income. You don't have to pay. You don't have to make a payment. The payment's up to you whether you pay back the loan or not.
And that's one of the questions that we just had over here. Even loans that you make, you have to pay back. Now, he is true. The loans have to be paid back, but two options do you have as far as paying that loan back?
Death benefit.
So you, number one, have the death benefit, meaning you can wait until you die, and all the loans are just simply just going to come from your death benefit. Meaning, say if someone had a $500,000 death benefit, and they used during their lifetime $200,000 of the cash value that they grew in their policy, $200,000 is owed plus interest to the company. So when they pass away, the first money that is going to be paid from that death benefit is going to be money back to the company plus interest. So let's say if it was 250,000 in total, that including the principal plus interest, the remaining 250,000 would go to beneficiaries. Or
I'm losing power.
now you got to plug it in. All good, all good.
Well, I'll see how much. Getting kind of flaky on me, and my dog is also annoying me. So I'm sorry, I interrupted you. I'm still
no,
on.
no.
Go
So
ahead.
I was just saying that there's two options. You can either let the death benefit pay your loans back, or you can pay your loan back yourself while you're living, and it's simply just going to add more equity to your account that you can redo the buy, borrow, repeat method, to meaning you can put more money back into your policy and leverage that money back out, buy other assets, utilize it for vacations, paying off debt, whatever you want to do. The money's yours. There's no strict repayments or anything like that. You have access to the capital that's in there, and from there it's just going to continue to grow. Whether you use the money or not, it's truly up to you.
Yeah, and the example I gave earlier of the young 30-year-old putting in 42,000 and in retirement getting 500,000 a year. By the way, even though taking $5,000 a year in tax-free loans, the death benefit is exceeding $2 million net of loans, net of the loan. So there's still a death benefit, even with loans in place to be paid off.
Exactly. You just continue to build an asset. Some see it as bad debt, and I could see the point of that, to where you're holding, let's say, a loan balance plus the interest. Or you can look at it as you have an asset that's going to out earn not only the loan, not only the cost of insurance, but also have growth in your monies, but also a death benefit if anything was to happen to you, because it's not if you die, but when you die. This is just one way to utilize your funds to build up an asset while utilizing them. Not many other places can do the same, and that's what we're here to educate on. I know you got to go out of here, Tom. I know I got a meeting coming up in the next top of the hour anyway, so
Sure.
I'll let you go. It was nice having you on, and then most likely let's get back to this hopefully in a week or so.
Yeah, that sounds great. Hey, thanks for inviting me. Appreciate it.
All righty,
God
have a good
bless
one.
you. Take care.
You too. Bye.